Your bank is not always looking out for you. And if you're retired, living on Social Security, a pension, or a fixed income, small banking habits can quietly cost you real money every single month. The frustrating part? Most of these mistakes feel completely normal. You may be making one right now without knowing it. There are 5 common ones, and one of them could leave a large chunk of your savings unprotected if your bank ever failed. Stay with me because that 5th mistake is the one almost nobody checks until it's too late. This matters most if you keep your money in one bank, live on a fixed income, share an account with an adult child, or haven't reviewed your account terms in years. If any of that sounds like you, these next few minutes are worth it. The first mistake is simple but expensive: paying monthly fees you could avoid entirely. Many checking and savings accounts come with a monthly maintenance fee. That's a charge the bank takes just for keeping your account open. On top of that, there may be overdraft fees, ATM fees, paper statement fees, and low balance fees. None of these buys you anything. They're just costs. Here quotes who this hits hardest. If you opened your account years ago and never switched, you may be on an old fee structure. Banks rarely call to tell you a cheaper account exists. They simply keep charging. Here quotes how it works in real life. Imagine a retiree who keeps a modest balance and gets charged a maintenance fee each month because the balance dips below a certain minimum. Over a full year, that quietly adds up to a meaningful amount of money. Money that came out of a fixed income for no benefit at all. So what should you do? Call your bank or log in and ask one direct question. What fees am I currently being charged, and how can I avoid them? Many banks waive the monthly fee if you set up direct deposit, keep a minimum balance, or switch to a no-fee account. Some banks offer accounts designed for older customers or for people receiving Social Security, with reduced or no fees. And in many cases, overdraft fees can be avoided completely by opting out of overdraft coverage on debit purchases. Now, one important thing to understand: not every fee is a mistake, and not every account is wrong for you. Some accounts charge a small fee but give you real value, like better fraud protection or higher interest. The mistake isn't paying a fee. The mistake is paying a fee you didn't know about and don't need. Those are two very different things. Also, be careful before you rush to close an old account. Sometimes a long-standing account gives you perks a new one won't. So compare first, then decide. The point here is control. You should know exactly what your bank charges you and why. If you can't explain a fee on your own statement, that's your signal to ask. But fees are the small stuff. The next mistake can cost you far more, and it involves the exact place most people feel safest keeping their money. The second mistake is about where your money sits and whether it's actually earning anything. Many seniors keep most of their savings in a basic checking or standard savings account. It feels safe, it feels simple. But here's the problem. Those accounts often pay almost no interest. Meanwhile, prices keep rising. So money that just sits there slowly loses buying power over time. It's safe from theft, but not safe from inflation. Why do so many people miss this? Because nothing looks wrong. The balance doesn't drop. The statement looks fine. But quietly, that money is doing far less work than it could. Let me give you a realistic picture. Say a retiree keeps a large emergency cushion in a standard savings account, earning almost nothing. Another person keeps the same amount in a high-yield savings account or a certificate of deposit at an FDIC-insured bank. Over a year, the second person may earn a noticeably larger return with the same level of federal insurance protection. Same safety, very different result. So what's the action here? First, check what interest rate you're actually earning right now. Most people have no idea. Then compare it to a high-yield savings account or a CD. A CD, or certificate of deposit, is an account where you agree to leave money untouched for a set period in exchange for a higher rate. But here's where you need to be careful, and this is the contrast that matters. Higher interest is good, but a CD locks your money up. If you might need those funds soon, a locked account is the wrong choice, because pulling money out early usually triggers a penalty. So this only makes sense for money you truly won't need for a while. Who might this not apply to? If you need every dollar accessible at all times, chasing higher interest may not be right for you. Liquidity, meaning quick access to your cash, can matter more than a slightly better rate. And one warning: never move money to an unfamiliar bank just because it advertises a high rate. Confirm it's FDIC insured first. We'll come back to that idea because it connects directly to the biggest mistake of all. For now, the takeaway is this: your money should be both safe and working. Most seniors only get the first half right. Which brings us to a mistake that isn't about earning money, It's about protecting the people you leave it to. The third mistake is one that causes real heartbreak for families, and it has nothing to do with fees or interest. It's about who gets your money when you're gone, and who can reach it while you're still here. Two tools matter most: a payable on death designation, often called a POD, and joint ownership. They sound similar. They are not. A payable on death designation lets you name a beneficiary on your bank account. While you're alive, that person has no access and no control. The money is entirely yours. But when you pass away, the funds go straight to that named person, usually without going through probate. Probate is the slow, sometimes costly court process of settling an estate. Skipping it can save your family months of waiting and a lot of stress. A joint account is different. A joint owner has full access to the money right now, today, the same as you. And that's where people get into trouble. Here quotes a realistic example. A widow adds her adult son to her checking account so he can help pay her bills. That feels loving and practical. But now that money is legally his too. If he's ever sued, gets divorced, or runs into debt, his creditors may be able to reach the funds in that shared account, even though it's really her money. One convenient decision quietly exposed her savings. So what should you check? Look at every account and ask, is there a beneficiary named? Is it up to date? Many people name a spouse decades ago and never update it after a death or a divorce. Whoever is listed is generally who gets the money, regardless of what your will says. That surprises people, so let me say it plainly. For many bank accounts, the beneficiary designation can override your will. What quotes the practical action? If you simply want someone to receive money after you pass, a payable on death beneficiary is often the safer choice because it doesn't give anyone access while you're alive. If you genuinely need help managing money now, a properly drawn financial power of attorney may protect you better than making someone a joint owner. That's a legal document naming someone to act for you without handing them ownership. Who might not need to worry? If your accounts are modest and your wishes are simple, this may be straightforward. But even then, 5 minutes confirming your beneficiaries is worth it. The most common misunderstanding? People think adding a family member to the account is the easy, safe option. Often, it's the risky one. And that risk is invisible until something goes wrong. Now we reach the two biggest mistakes, and the last one is the single most important thing in this entire list. The fourth mistake is one of the easiest to fix and one of the most dangerous to ignore: not watching your own account closely. Many people glance at their balance and assume everything's fine. But fraud against older adults keeps rising, and scammers count on you not looking closely. A small unauthorized charge, a strange withdrawal, a subscription you never signed up for, these often slip by for months. Why do people miss it? Because reviewing statements feels tedious, and because we trust that the bank will catch problems for us. But the person most likely to spot something wrong on your account is you. Here quotes a realistic example. A retiree notices a small recurring charge she doesn't recognize. It's minor, so it's easy to ignore. But it turns out someone had her card number and was testing it with tiny charges before attempting a large one. Because she caught it early and called the bank, the bigger loss never happened. The practical result is huge. With debit and credit cards, the sooner you report unauthorized activity, the better your protection generally is. Waiting can reduce what you're able to recover. Speed protects your money. So what should you do? Turn on account alerts. Most banks let you get a text or email for any transaction over a certain amount, or for any withdrawal. Then, actually read your statement each month. You're not looking for big, obvious theft. You're looking for the small, quiet charges that don't belong. One caution here: don't assume every unfamiliar charge is fraud. Sometimes it's a forgotten subscription or a store name you don't recognize. Check first, then act. The goal is awareness, not panic. This mistake sets up the final one because the scammers who target your account are the same reason the last point matters so much. Here quotes the mistake almost nobody checks, and the one that can cost you the most: assuming all of your money is protected simply because it's in the bank. This is the strongest point on the list, and here's why it matters more than the others. Fees cost you a little each month. This mistake could cost you a large portion of your life savings in a single event, if your bank ever failed and your money wasn't fully covered. Let me explain the mechanism clearly. The FDIC, the Federal Deposit Insurance Corporation, protects your deposits if an insured bank fails. The standard coverage is $250,000 per depositor per insured bank for each ownership category. Read that carefully. It's not $250,000 total for everything you own everywhere. It's per bank and per ownership category. Here quotes what trips people up. If you have more than $250,000 at a single bank in your name alone, the amount above that limit may not be insured. Many people don't realize this until they've sold a home or received an inheritance and parked it all in one place. Here quotes a clear example. Suppose someone keeps $300,000 in a single account in their name at one bank. In a bank failure, only $250,000 would be covered by the standard limit. The rest could be at risk. But here's the reassuring part and the mechanism that solves it. You can be insured for far more than $250,000. You just have to structure it right. Money in different ownership categories is insured separately. A single account, a joint account, and certain trust accounts each get their own coverage. So a married couple, using individual and joint accounts, can be protected for well beyond $250,000 at the very same bank. And spreading money across separate insured banks multiplies your protection too. The most important limitation: this only applies to FDIC-insured banks or NCUA-insured credit unions, which offer similar protection. Investments like stocks, bonds, and mutual funds are not FDIC-insured, even when you buy them through a bank. That distinction catches many people off guard. The biggest misunderstanding? People assume it's in the bank, so it's safe. Safety depends on the amount, the bank, and the ownership category. The correct next step is simple. Add up what you hold at each bank. If any single bank holds more than $250,000 in one category, look at spreading it out or restructuring. The FDIC even offers a free online tool to estimate your exact coverage. Checking takes minutes. Not checking could cost you everything above the limits. Let quotes turn all of this into a clear plan you can follow in order. First, review your current statements. Pull up the last month or two and find every fee and every charge. This comes first because you can't fix what you haven't seen. Circle anything you don't recognize or understand. Next, call your bank or log in and ask directly how to eliminate avoidable fees. Ask about no-fee accounts, direct deposit waivers, and opting out of overdraft coverage. Do this early because it's the fastest way to stop money from leaking each month. Then, check what interest you're actually earning and compare it to a high-yield savings account or a CD at an insured bank. Only move money you won't need soon and confirm any new bank is FDIC insured before transferring a single dollar. After that, review the ownership and beneficiaries on every account. Confirm each payable on death designation is current. Think carefully before making anyone a joint owner and consider whether a power of attorney fits your situation better. Update anything that's outdated. Finally, add up your total deposits at each bank and confirm you're fully insured. If any single bank holds more than the coverage limit in one category, spread it out or restructure. Turn on account alerts while you're at it. The order matters because each step builds on the last. You find the problems first, stop the bleeding second, grow your money third, protect your family fourth, and shield your savings last. Rushing to move money before you understand your coverage is how mistakes happen. Slow and clear wins here. Here quotes a scam warning worth remembering. Your real bank will never call, text, or email you and pressure you to move your money to keep it safe, or ask you to read back a code, PIN, or password. That is one of the most common tricks used against older adults right now. Scammers spoof caller ID so the call looks like it's from your bank. They create urgency because urgency makes people skip their normal caution. If you ever get a call like that, hang up. Then call your bank using the number printed on the back of your card or on your official statement, not a number the caller gave you. A genuine bank will not mind you calling back to verify. Real institutions expect careful customers. Anyone who gets angry when you want to verify is telling you something important about who they really are. So let's bring it home. 5 common banking mistakes: paying avoidable fees, letting your money sit without earning, naming the wrong people on your accounts, ignoring your statements, and not knowing whether your money is fully insured. The people most affected are those on a fixed income, those with everything in one bank, and those who haven't reviewed their accounts in years. The strongest point, and the one to act on today, is that FDIC insurance is $250,000 per depositor, per bank, per ownership category, not unlimited, and not automatic above that line. If you do just one thing, Add up your deposits at each bank and confirm you're fully covered. It's free, it's quick, and it protects the savings you worked a lifetime to build. You are not powerless here. You're in control. You just needed to know where to look. If this helped, consider subscribing so you don't miss the next one.